Let's dive deeper into Apple right now. The stock is down more than 2.5% today, closing below its 200-day moving average for the first time since last June. It is now off more than 17% from its 52-week high, and the Chartmaster says investors should be ready for more pain ahead. Let's get to Carter Worth of Worth Charting. Carter, what do you see?
Well, it's very heavy, and we'll look at the charts, but the main thing is that this is perhaps the most widely held stock in the planet, and it is really only as of now garden variety in terms of the sell-off. And we'll look at the stats together. Let's look at the first chart. And so what do we know? There are no judgments here except that arrow. I put that arrow in, but it's a well-defined uptrend. And that line connects the COVID low with the sell-off in September, with the sell-off in the beginning of this year. And then here we are. We broke trend almost a week and a half ago. Now, look at the second chart. And where might we go? Well, we're into support. You can see the horizontal line. The peak, of course, was Gen 4, and we're down from actual peak to now 17.92%. That high was 182.94 is all we'll know. So where can we go? It's anybody's guess. Here's mine. Third chart. That peak, that spike that you see there where the second line is drawn, that was September 2nd of 2020. At that point, Apple was trading some 65% above its 150-day moving average. Compare that to its dot-com peak, it was only about 80%, meaning that was one of the most extended moves on record. I think we'll retrace to that level. That level is 138. And so the final chart, that would represent a 25% decline, were we simply to go back to the September 2nd spike high when it was so very extended above trend. Now, 25%, we're down, what, 18 now. Is that garden variety? It actually is. Final table, take a look at this. So this depicts, in summary form, every 15% plus decline in Apple since the financial crisis low in 2009. So there have been 10 instances where the stock sold off 15% or more. And the average decline of those 10 instances, you can see it right there, is negative 30.7. The median is negative 29.4, and here we are down 18 plus. And so why can't it do what it did in 2013? It dropped 45%. 2016, it dropped 33. Support, we're into it, but support is not a plywood board or a concrete floor. It's a mattress top, and you sink into support. At some point, it'll find it, but I don't think it's here.
Is your guess that if Apple reaches that point of 138, that around there, that's where the market finds its footing more broadly?
Well, that would be interesting, right? Because what we know is that the market itself, the internals are as bad as you could have it. We know that half of all stocks in the Russell 3000 have basically lost more than 25%. And we know that 25% of the Russell 2000 is down more than 50%. So what you need to see is some of these last holdouts, and then add to that big energy names finally giving way, or financials getting worse, and you can get your market down more than it is now, which is only down 13% on the Russell.
Carter, thank you. Carter Braxton Worth of Worth Charting. Pete, what's your outlook for Apple? I know you loved it in the past, loved it. Now what?
I continue to love it, but I will say with a little caveat that I love it, but I'm not buying more just yet. Matter of fact, if it got down to those levels that Carter's talking about, 138, I probably would get interested then, Mel. But, you know, Apple, like a lot of names, did get a little bit stretched. We all talked about the valuation levels that a lot of these various names did get to. So this pullback, I think what really makes me feel a little bit better, not a lot better, but a little bit better about what's going on with Apple is the implied volatility. So in other words, as you know, any stock that I own, I will sell calls against it when it makes sense. And right now, when you look at Apple, it was trading implied volatility at about a 30 or a 31. Now that implied volatility of the near-term options in March and going out to April is above 40. As a matter of fact, it's as high as 47 in the shorter term, 42, then down to 41 when you get to April. So if I can collect against Apple selling, and I'm getting much more a premium now than I was, It's exactly what I'm going to do. We've already got the dividend yield. We know about the buybacks, but this gives me the advantage to be able to hold on where I'm selling implied volatility of out-of-the-money calls to get that kind of premium. That's a pretty high premium for Apple. You don't normally see that. So it gives me at least a little bit of comfort that I can get a little bit more premium and make these push to the downsides feel a little bit better. Not a lot better, but a little bit better as they fall.
Just quick, Guy, do you think that if Apple reaches that 138 level, which would be less than the average decline, as Carter had said, for Apple, which is 30%, that the markets will be close to a low?
Yeah, I think that's exactly what you're waiting for.
Sorry about that.
I'm sorry.
Go ahead, Guy.
I'm sorry, Mel. I'm sorry, Jeff. No, what I was going to say quickly was that 138 level, that's the low we saw on October 4th, and then we obviously had a significant bounce. So Pete's looking at this exactly the right way. Use volatility as your friend, but it also suggests you probably have further room to the downside. So 138 lines up really well, and it should, in my opinion, coincide with an S&P 500 that might get down to that 4,000 level or so. So I'm with you on that one.